Good morning, everybody. We're going to do a quick look on volatility, and we will dive into that. So for those who don't know, volatility is just the probability of an asset will go up and down in price. And there's a variety of ways to measure that, but we're not going to go in that today. But in general, the volatility of crypto is very high. As we all know, we're all here making money mainly on LPing, which is how you would make money on the price swings up or down of an asset. So today I just wanted to go over a few tokens and LP positions I'm interested in, and then also how you can hedge to reduce your exposure to the price volatility, but still earn money off of the volatility. I think I've done this a little bit before, but today we'll go into some more specifics that I looked up on the Know What Else channel, and then some stuff that I'm just interested in, like I said. So let's start with the stuff I'm interested in. We're going to pull up. You should be able to see Uniswap right now. Amazing. So right now there's a pool I was going to explore that I'm interested in, and it is an aave uni pool. And I'll tell you why I'm interested in both of these. So there's some catalyst events that are about to happen. So let's go look at the pools. So aave ETH is doing a ton of trading volume. One that's doing a lot less trading volume, but it's still really interesting to me is the uni aave pool. And then I don't know, wow, staked aave killing it over here. So these are all really great pools. This is all in mainnet. You also can go take a look at stuff on Polygon as well, because they have some good aave pools there. But the one we're going to look at today is uni aave. So as you saw right now, it's annualized something like 13% APR, which isn't insane, but it's really interesting as well because you get to take on the risk or the upside and downside, but of uni and aave in a more elegant way. So the reason I'm interested, I will go to the next page here. So now I'm going to go over to the Uniswap forums. The big thing that's been happening, if you haven't been living on a rock, is that the Uniswap fee switch has been discussed multiple times. I can't find the one I'm looking for, but it's all good. The point is, there's been a huge push to have a fee switch come back on. And one of the big things that happened last time was A16Z, which is a big VC firm. They weren't ready. They didn't think the ecosystem was ready for it. And so that was the limiting factor. They voted no on the proposal. But many people have wanted it. Many people are excited about it. They recently, A16Z recently released an analysis of how to effectively distribute cash flow to tokens and token holders. So this is basically the only reason they're doing this because of Uniswap. That's one of their biggest investments, and also it is probably the biggest cash flow generating business that they own in crypto right now. Fun fact, Uniswap is not the actual biggest cash flowing one. I believe if you take their fee, if you like prorate their fee, they do about 30 million annualized, which is really, really good. Aave is very close. And then also there's a few dexes on Base and a few dexes on, I believe it's Binance Chain, that are also sitting at equal or close to the equal amount of money back to their users. So very, very competitive landscape, but this just goes over a more clear way that they think is legally compliant to do this, which we'll probably be seeing as well on the fee switch turning on. And so that's something to look out for as well. Then finally, I'm not going to pull up anything for this, but UniV4 is supposed to come out in it said Q3, but we're just going to say Q4, maybe even Q1 of next year. So in the next 3 to 6 months, UniV4 will come out. So these are all catalyst events for Uniswap to have some price movement. I actually don't, well, I think personally it'll go up, yes, but like that's not financial advice. The point is that there is volatility going to be happening. So the price of the token will move drastically over the next 6 months in either up or down. So just depending on what people are thinking. The reason that I find that aave uni pool to be so interesting, even though it's making less fees, is because you also have the aave token that is doing almost identical things to Uniswap. They're, if you go through their forums, they're looking about turning on the fee switch. There's a little more defined on how they're doing that. And then the big thing that is happening as well is they have, as I said, they have more defined systems where they're trying to get their stable token to be above 300 million market cap. It's at 150 right now before they turn the fee switch, so it's about halfway there. They have a move to reduce the safety module, or at least change the safety module from being aave. It's right now, if you're not familiar with the aave's system, it's all backed by the insurance fund is all backed by aave tokens. So for instance, if there's a horrible loss or bad debt that happened tomorrow that goes above their thresholds, there's a consensus moment where the staked aave will be used they'll sell the aave token, which is not great for the price of aave token, to plug that hole. And right now they haven't had to do that because they've been so amazing with their security and compliance, all that good stuff. Awesome. But they realize how detrimental that can be to their token and token holders if they have to do a socialized loss. And then the socialized loss also happens to be specifically on their token. So they're trying to mitigate that, and they go into their next. They're having to be something next, but they're trying to better reduce their exposure for their token. So that's all great catalyst events again. Given the current track rate and how much money they're spending on the Go token, we can expect something to at least more information to come out on that fee switch being turned on or off in the next 6 months as well. So you have this moment where you're able to, if you have start to build out a thesis on like, I think Aave is going to do well over this amount of time because they're turning the fee switch. I think Uni is going to do well because they're turning the fee switch. Or they can do bad. I think they're going to do horrible for both of them. You're able to say, okay, how can I make money on this volatility, this market movement? This is a position on Uniswap right now in this. Right now, it's not doing great. The market has changed, shifted on me, but I'm still in range. Looking at Aave. So for every ratio for 20 Aave, 20 Uniswap equals 1 Aave token. Sorry. That is been in range for, as you can see down here, the past 30 days, 40 days, something like that. Basically, right before this point over here kind of starts the run that Aave had upward. I didn't enter this position until 10 days ago. So 10 days ago, I didn't start the position until 10 days, which was basically an all-time high for the ratio. But I've been able to earn from a hodl position. I've lost money, but on the overall, I've been able to earn $83 on this. I still have a strong feeling this is going to be bouncing back and forth for the next 3 to 6 months, and I get to earn that volatility while still having the opportunity to take some of the upside with Uni and Aave having the fee switch turn on. So this is a long-term play, but it allows me to play volatility and still hedge my bets, as well as because the range is so wide, it's really wide range. I reduced my IL in the overall. So very, very interesting position. We'll see how it goes. But say you don't like this volatility. Say you're like, I don't want to deal with the price movement at all. I don't want that upside. I just want to take that sweet 13%, or right now it's actually closer to 30% APR. You can go onto a lovely Perps exchange, and we'll show you how to do this with Perps and options of it. Perps exchange, let's see which one we go to. I use AVO. Some people use Hyperliquid. I think Hyperliquid is probably going to be the better of the two in the future. AVO's another one that got kind of beat up these past months. But so for instance, I realize I don't have my VPN on, so this might mess some things up, but we're going to see. Nah, we won't do it. We're just going to leave it be and say I can't connect. But in this case, you would take out sell. So you'd sell the equivalent amount of your starting Aave. Let me go look at what that is and revert. In my case, that would be, I put 24 Aave in. So I'd short 24 Aave. I have a little ghost token, and if I connected, press buy there, and then I would go do the same thing for the Uni. Oh, I don't have Uniswap on here. I guess we got to go to Hyperliquid. That's one thing you have to do when you do this kind of short. You have to check to see if they have the markets for it. Okay, Hyperliquid does. So you go to Hyperliquid. So we do the same general thing here. We would look at, I'd go back to revert. I'm going to look again and see 825 or 875 Uni, and I would want to short that as well. So now I have taken, by having that LP position, I was originally long 875 Uni. I was originally long 24 Aave. And now, in this hypothetical example, I would have taken a short position on both sides. So we have Uni can go up in price by holding that spot. Aave can go up in price by holding that spot. And then if we take out a short on the Uni and the Aave of equal size to both of those starting positions, we now have the ability, as long as we're staying in range in our LP position, to earn a delta neutral amount. That's earn that applied APR. So that 13% we started at the beginning, I'll go back to it right now. This right here would be our risk-free rate. So this would be what we'd be earning if we basically created a delta neutral position, or a box spread almost. So as long as we're within our LP range, we would be able to earn a risk-free 13%. You can up that actually by doing the same shorting system and doing Aave ETH, or even staked I don't know how the staked aave would work, because I don't know how much staked aave goes up and down per se by your range, but you definitely start to create something there where, and all you would be doing is shorting aave, because you would take your total amount of aave in the position and staked aave and maybe a little buffer, so you'd be a little bit higher on your short, and then you could short that. As long as you stay in range, you'd earn a risk-free rate of 180%. That's really, really good. But yeah, you have to play with the numbers on that one. But anyways, that's the way that by taking those short positions out and with the long, you now reduce your concern about price movement. Excuse me, you're only concerned now about trading fees, which is very nice in down or choppy markets like this. So that's really good. It also gives you the ability to have a more like consistent way of making revenue. So if you're looking for income-based stuff, this is really good for that. Let's take another look at, so you only can use perps to do this type of short. If you wanted to do one, or this type of delta neutral strategy, if you wanted to do one with options, it's a little bit, it's easier to execute. It's harder to make sure that you are profitable. You can go to your favorite options platform. It could be Deriv, it could be Premia, which is where I work. It could be, I think there's only two that I can think of. Oh, if you're not in America, you can go to Deribits, which is the centralized exchange for options. All are great places. And the biggest reason you want to use options is because they have no risk of liquidation. So with perps, even at 1x leverage, you have a small risk of liquidation. Actually, you have a risk of liquidation. We won't say a small risk, risk of liquidation, especially on places that don't only allow for USDC deposits. For instance, the reason I like using aave is because the deposits can be in ETH, USDC, or BTC. So you still have the ability to do something where, for instance, if you were in a aave ETH LP, you could use ETH and USDC, but ETH as your collateral to short that position, which allows you to, one, never really liquidate on your ETH position ever, which is awesome. And then two, with the aave, if ETH is ripping and aave is going down, your collateral's great in that regard. So it really makes it difficult to get liquidated in that regard. And then if aave is ripping and ETH's not, it's still a stronger collateral type than just having USDC. So they're highly correlated assets. So with options, the reason that it's a little bit more difficult is because you only can do it on the majors. So ETH, Bitcoin, Sol. Let's see if they have anything else on options. Yeah, just ETH and Bitcoin. They don't even have Sol on Deriv. This is what it looks like. And it's kind of insane to look at for the first time, but this is where the price is right here at the 2,400 mark. What I would suggest people do is, if you want to use short position, say you're an ETH USDC LP and you know your bands. So say your bands are from 2,000 to 2,800, something like that. And for your range, you can say, I want to buy downside protection starting at 22,000 right here. So 2,000 as far out as possible. Wow, that is next year. Wow, that's pretty cool. I didn't know you could do that. So for every ETH you have, you want to hedge. So you would be able to say, I would like to buy, wow, the spreads are fucking crazy too. I'd like to buy in the money $2,000 ETH puts. So you buy these. That's going to cost you a little over $1,700, but you are now protected for the next year up to 5 ETH. So if the price is below $2,000, you start to be in the money in your option. The premium is included in that, so that's a little difficult, but a little bit more. You need to be a little bit more in the money, but you're a year out. If the price of ETH goes down to 1,500 or something like that, you're definitely in the money. And then you're also able to know your fixed cost of what you need to make up in the future to make sure that you are profitable on this hedge, which is really nice. So you know your fixed cost. So what do you need to make on your LP position in the next year? 1735, which I think is pretty doable on 5 ETH. And then the next part is if you want to exit your position, at any point, you're able to sell these contracts back to the Deriv marketplace. Let's go look at something a little closer. So it's October 2nd. Let's do end of the month expiries. Let's do 2,500. You do a little in the money. So like if you're having a little out of the money, if you think that the price will drop below your 2,000 mark. So basically, if you're like at the end of the month, I'm going to have a range of, we still stick to that 2,000 to 2,800 mark, and I think the price of ETH, I want to have protection. If the price of ETH starts to go down, you could start to buy up 2,200 to 2,100 puts. And then if the price starts dropping, you start to make money off of those as they cross your break-even points. And you once again have a fixed price for your downside protection. And you're able to say, as long as they make more, I'm protected to make more than if we did, let's see 2,200. The same 5 contracts is $270. So if as long as you make $270, you are in the money for your downside protection. And that means that if the price doesn't go down, but you made above $270, you are doing great. You're doing you're protected to the downside, and now you have risk-free profit. So it's a pretty straightforward calculation, but it really helps you understand how to hedge your bets, express your given outlook on the market, and also just cover your butt in case there's volatility or things that are going on. One of the big things right now is the election. We just had the vice presidential debate, and there's some other stuff coming up. We had the rate cuts and everything, but in general, it's like a very rough time to be trading, and so de-risking yourself with options or perps is really, really helpful. But yeah, I think we're a good place to stop. Hopefully you guys glean some things out of this. If you guys have any questions, feel free to ask. I don't run all these strategies all the time, but I definitely have run every strategy I mentioned today. As you saw earlier, I'm in a aave uni position. I'm unhedged in that one. I want the upside. I think there'll be some upside over the next 6 months, especially in uni side of the house. Aave's already had its run. And then if you guys are interested in more delta neutral strategies or things that reduce your risk, just hit me up, and yeah, just have a great day. Thanks, guys.